Hello and welcome to Switzer Investing Insights, brought to you by nabtrade, and we're into the final week of reporting season. We've got three well-known companies to have a look at. Paul, let's kick off with Woolworths.
Yeah, look, a pretty strong report from Woolworths. Peter, sales up, profit down. That was pretty much as expected. A final dividend of 48 cents again. That's pretty much how the market had telegraphed. So for shareholders, 94 cents this year versus 102 cents last year. Now, we know supermarkets have been booming. Sales have up, margins have been up as well in terms of, you might have noticed the prices have been going up a little bit.
Toilet paper's more expensive than it used to be.
Improved gross margin, but they've had a lot of higher costs to do with COVID-19. So that's why the earnings haven't gone up, only got up by 6.3%. The other thing about Woolworths, Big W is back in the black, and also a good, strong performance by Endeavour Drinks. But that's the hotels division, which has been pretty closed, or not closed, but hotels have been really suffering since COVID-19. That's why the actual profit was actually down 1.2%.
Yeah, that would be a real negative there, for sure.
So the positives for Woolworths, I mentioned Big W back in the black, which I think is a real positive. Also, Woolworths and Coles has been catching up in the sales over the last couple of halves. In fact, that margin has almost has narrowed. But Woolworths got their nose back in front again in the final quarter, so with sales growth of 8.9% compared to Coles with 7.1%. And a strong start to FY21, up 11.9% after the first 8 weeks. They have warned they're a lot higher cost because of COVID-19. That's more team members, more cleaning,
masks and everything.
Masks. It's also the costs around logistics and delivery, of course. But you know, look, Woolworths looking pretty good.
Yeah, and I've got to say, Paul, I've been seen in Big W in recent times. Quite surprised how a good value some of the stuff is in Big W. I'm not surprised it's in the black. Let's go now to Ramsay.
Yeah, look, Ramsay Healthcare, I mean, they're a company that's Australia's largest private hospital operator, also in the UK and France and in continental Europe. And the private hospitals have obviously been have struggled because of COVID-19. You can see in Australia, they basically closed down, no elective surgery, so no one reason to go to a private hospital. And then they've become facilities available for government to use as an overflow. That's been the situation in the UK and also continental Europe. So overall, for the year, revenue was up 7.3%. But that reflected the full-year contribution from Capio, which is their business they acquired in continental Europe. So overall, if you take that away, revenue was down. Core NPAT down 43% to $337 million. Their biggest division, which is the Australian hospitals, and they're the biggest operator of private hospitals in Australia, revenue down 2.2% to $5.1 billion, and all of that was in the second half. They said that up until February, they were on track for quite a good, strong full-year result, but obviously COVID-19 has had a big impact. Shareholders are feeling that pain as well, no final dividend. Look, declined to provide guidance for FY21 due to the COVID-19 uncertainties. We've seen that with the lockdowns in Victoria. Overall, look, not a strong result, but I think the market was probably fearing a pretty bad result. It wasn't as bad as it might have been. There were fears from some analysts that this could have been a real shocker. It wasn't as bad as that, and in some ways a little bit of a relief rally. So, you know, Ramsay shares around $66. The market was reasonably comfortable with that.
And they've been affected by the fact that elective surgery has been put on hold while the coronavirus issues have been dealt with. And of course, Victoria going into lockdown also doesn't help them improve their outlook as well. So I can see why there's no guidance. Let's go to APA Group now, Paul.
Now, put APA Group in here because I think this actually provided a bit of a buying opportunity for income investors, because on the back of this result, the market sold off a little bit. So I think if you look at it was a bit surprising. So first of all, EBITDA was up 5.1% to $1,654 million. That was right at the top of their guidance. The company had previously guided to this. Net PAT was up 10.1% to $317 million, and a final distribution of 27 cents, taking a full year to 50 cents per share. There's a little bit of franking in that. So that's a yield of about 5% when you gross up for the franking. Now, that was all expected and that was all good. Looking ahead, their guidance for next year was just a little short of where the market was, about 1625 to 1665. For basically EBITDA, maybe a small contraction next year. And the distribution of around 50 cents, that also was a little less than the market had been hoping for, about 52 cents, 53 cents. So on the back of that, we got a bit of a sell-off. But I think if you look at this group, you pour into it, about 90% of revenue is pretty much contracted. It's very capital intensive, and they've got a great track record in both distributions and in both EBITDA growth and EBITDA guides. So have a look at this graph. This shows you their EBITDA from over the last 12 years, from 2009 up to 2020. You can see it's been growing each year. May not grow next year, but look, but what the interesting part here is their guidance. So the company does guide to this each year, Peter. That's the black horizontal line. Sometimes you get a little range, and you can see that each year they've delivered on guidance. So I think there's a pretty high degree of confidence about what you look forward to next year, FY21. Have a look at the distribution chart, which also shows with one small reduction, this covers 20 years between 2001 and 2002. The distribution has grown each year. Look, it's
more than doubled over that time.
This is an energy infrastructure business, you know, with the gas pipelines, very reliable contractual terms, long-term contracts. Biggest contract is to do with transfer of gas up to the Gladstone LNG export facility, but they're in New South Wales with things like the Moomba to Sydney gas pipeline, big in WA, increasingly bringing on gas processing, and also renewable energy power generation is becoming more important. I think as an investor, as an income player, this is a really low-risk way to actually get some reasonable
And what's
income.
the gross up yield?
Yeah, just on 5% is what you can get on this company at the moment. You aren't going to make a fortune. The share price ain't going to rocket. They're all the normal single event risks. The MD does something crazy. You know, they have a big explosion.
A government change of policy.
Government changes regulation. You can't take away those sort of single event risks. But as a reasonably low risk way to get some income, I think this is pretty attractive.
Exactly. So that's Switzer Investing Insights brought to you by nabtrade. Thanks for joining us.